Hey everyone, welcome back to the channel. The latest real estate numbers are in, and they're not pretty. We are seeing more power of sales and people are forced to sell. For example, this Ajax home was sold at a loss of $1.1 million. In August 2024, it was sold for $2.3 million, and now in September 2025, it is sold for $1.2 million by the bank. The Toronto Regional Real Estate Board just released its October 2025 Market Watch report, and it confirms what many have been fearing. Toronto's housing market continues to slide deeper into correction territory. Prices are down. Sales have dropped to the third lowest October in the past 12 years, and now reports of power of sale listings, delinquencies and mortgage defaults are accelerating across the Greater Toronto area. Let's break down what's happening and what this means for homeowners, buyers and investors heading into 2026. The latest numbers, a market under pressure. Let's start with the headline figures straight from Toronto Regional Real Estate Board's report. Benchmark price. The benchmark home prices, which reflects the most common set of features buyers look for, fell again. It dropped from $960,300 in September 2025 to $956,800 in October 2025. A decline of about $3,500 in just 1 month and down over $103,000 compared to last year. Remember when we were told earlier this year that rate cuts would bring buyers flooding back? Well, that clearly didn't happen. Average price. Toronto's average home price dipped from $1,059,000 in September to $1,054,000 in October, down about $5,000 month over month and roughly $81,000 lower than a year ago. Median price. The median price, where half of homes sell above and half below, slid from $909,000 in September to an even $900,000 in October. That's a $10,000 drop in a single month and $60,000 below October 2024. So in every major category, benchmark, average and median, prices are heading lower month after month. Supply and demand. More homes, fewer buyers. The sale price to list price ratio, SP/LP, which shows how close homes sell to their asking price, held steady at 98%. But the biggest story here is inventory. The months of inventory climbed again, from 4.6 months in September to 4.7 months in October. That's the highest months of inventory Toronto has seen in more than a decade, showing that supply continues to outpace demand. And when inventory builds up, prices almost always follow downward, exactly what we're seeing now. The sales volume. One of the weakest Octobers in over a decade, home sales came in at 6,138 units in October 2025, down about 10% compared to last year and marking the third lowest October in the past 12 years. Meanwhile, new listings surged to 16,069, the second highest level in 12 years, and active listings hit 27,808, the highest inventory level heading into November since 2013. That combination, falling sales, rising listings, and mounting inventory, spells more pressure on home prices in the months ahead. Power of sales and defaults are rising fast. Beyond the stats, we're now seeing a wave of forced sales and mortgage delinquencies spreading across the GTA, from Brock to Ajax, Stouffville, Oshawa, and Brampton. And here's what's different this time. It's not just private lenders feeling the pain. Mid-sized banks, like Equitable Bank, are reporting sharp increases in impaired loans, and even the Big Five banks aren't immune. CIBC recently warned of further mortgage default risk heading into 2026. That tells us the stress is broad-based. It's no longer isolated to alternative lending or over-leveraged investors. It's now hitting regular homeowners, even those financed through traditional institutions. Why it's happening? The math is simple and brutal. Since 2022, Toronto home values have lost around $400,000 on the benchmark price from the peak. When equity evaporates, homeowners lose flexibility. They can't refinance, they can't borrow against their homes, and when renewal time comes with much higher rates, many simply can't keep up with payments. At first, this strain showed up in private lending data, then moved to alternative lenders, and now even the major banks are reporting higher delinquency rates. This is the natural progression we see in every real estate downturn: private arrow, alternative arrow banks. And unfortunately, we're only in the middle of that cycle. Make what lies ahead. 2026 could be the real test. Both CIBC and Morningstar have issued warnings about mortgage renewal risk in 2026. Many of the loans already defaulting are short-term renewals from private and alternative lenders, meaning the next big wave, those 3 to 5 year bank mortgages, will reset next year. Add in 6.9% unemployment and ongoing corporate layoffs, and it's hard to imagine pressure easing anytime soon. In other words, 2026 could be the toughest year yet for the housing market. 5 key takeaways. So here's where things stand right now. Benchmark price down 3,500 month over month, down 103,500 year over year. Average price down $5,000 month over month, down to $81,000 year over year. Median price down to $10,000, down to $60,000, YY. Sales 6,138, third lowest October in 12 years. Inventory 4.7 months, highest in over a decade. All pointing to one conclusion: Toronto's housing market is still sliding, and the next 6 to 12 months could bring even more turbulence. So, what does this mean for you? If you're a buyer, patience and negotiation are your best tools right now. If you're a homeowner or investor, focus on liquidity, watch your debt levels, and plan early for renewal. And if you're a seller, pricing your property right could make the difference between a sale and sitting on the sidelines. We'll be covering how Canada's national housing data compares when it's released later this month, so make sure you like, subscribe, and turn on notifications for that update. Thanks for watching, and as always, stay informed, stay strategic, and stay real about real estate.